Hello and welcome. Thank you so much for joining us today. We've got people still hopping on here. We got about 30 more people hopping in, so we're gonna give them a little bit of time. But as we go here, I just want to say thank you. I know it's a busy day, and I really appreciate you taking some time today to learn about passive real estate investing. So I've seen a lot of familiar faces, some folks I know that are hopping on, lots of new folks as well. So thank you all so much for joining me. We're going to get right into it here, and we'll just let people come on in as they're coming here. So let me move to where you can see my slides a little bit better here. So hopefully you are here for figuring out what passive real estate investing is all about. If not, you are in the wrong place, but we welcome you anyway. All right, so have to do the disclaimer. I am not a CPA. I'm not a financial advisor. I'm not a attorney. I am just a real estate investor like yourself, perhaps, and a business owner. And I'm just kind of sharing what I know. And yeah, we'll get into my roles a little bit more. But just so you know, if you would like copies of the slides that we have, feel free to text me. Just text the word slides, and we'll give you a copy of all of these so you don't have to take furious notes. I know it can be hard to take notes and listen at the same time. So if you want a copy of the slides, feel free to text me and I'll be happy to give those to you. And if you missed the number here, I'll show it again towards the end because, again, I know there's some people still hopping on here. So feel free to do that. So a little bit about me. My name's Maria Zondervan. That is a Dutch last name, but I'm actually Swedish. That's where my company comes from, company named Blue Vikings Capital. I'm a Viking from Sweden, born and raised there, but I have been living the vast majority of my life in the US now. So I am what's called a capital allocator. And what that means is I work for investors, not for deal sponsors. I mainly look to invest my own money in projects, and then I invite others to invest alongside of me so we can get better returns. When you bring a bigger check to the table, they always give you better returns. So if I come in alone, I'll get one set of returns. If I come in with a group, they're going to give us all better returns. So that's what I am. I look for good deals to invest my money, and I ask others if they want to join me, basically. So I do have a personal real estate portfolio as well. So I do this full time. I have both single family homes as well as apartment complexes that I own 100%, no investors. But then I also invest in what's called real estate syndications, more both actively and passively. And we'll talk about the difference between active and passive investing. But syndications, if you're not familiar with that term, it basically just means a lot of people pool their monies to buy something that they might not be able to afford on their own if they were just investing on their own, right? So you can buy something bigger by working together in partnerships. So that's basically what a syndication is. And you can syndicate just about anything, not just real estate. There are people who syndicate businesses, all sorts of things. So I do that. So I invest in a lot of different types of a lot of different things using syndications, and I'll get into some of that. I am also a business owner. So my husband and I, we own 2 Massage Envy clinics here in Florida. And basically what we do is we take the cash flow that those businesses produce, and once a quarter, we pull out a chunk of money of that to put into some sort of passive investing. So that's kind of how we got into the passive part. And it's great for if you have a business and it does do as well one quarter as you might like, you've got that other passive income coming in that kind of buffers you. So I invest in every property that I invite others to invest in. I never put out something and say, hey, I think you guys should all invest in this if my money isn't in there as well. So, and I offer both direct investments in properties as well as through funds. And we'll talk about what funds are and how that can be a benefit as well. And I currently hold investments in 6 different states, plus in Puerto Rico. That's the beautiful thing about passive investing is you don't necessarily have to be where the properties are. So you have the opportunity to invest all over the place, which is nice. And I am also a busy mom. I have 2 boys, 2 wonderful boys, and my oldest son has autism. So he is a lot of my why of why I do this. I want to make sure I leave some legacy wealth for him to take care of him forever because don't know what his financial future is going to be. So that is my big why is my boys. All right. A little bit about Blue Vikings Capital. I mentioned where the name came from, being Swedish. I've got that Viking blood in me. But I'm a firm believer that real estate is the most powerful investment tool out there. There's just nothing else that produces such consistent returns as real estate, and just tends to always appreciate, right? We know that long term, yeah, it's got ups and downs and all that kind of stuff. But when you look at what real estate used to cost and what it costs now, we know we have that long term appreciation. And then it comes with tons of tax benefits. But there are different levels of risk and different things that you invest in. So my whole philosophy is let find the greatest returns for the least amount of risk. I'm trying to balance that teeter totter, if you will. So that's kind of what it's all about. And then I really believe in communications. I think there's nothing worse than investing in something than just not hearing anything about how it's going on. So I make sure to keep regular tabs on everything that's happening in my portfolio and sharing that with all of the investors that are investing with me. Here's just a few examples of some of the properties we've invested in lately. So you can see that they're kind of all over the place. We've got properties in Florida, Texas, Ohio. Again, that's the beauty of passive investing. You don't have to invest where you're at. You just have to look at good, strong, growing markets where there's some sort of appeal, where you can get a great deal on a property, that sort of thing. I like for them to be big enough that you get the benefits of economies of scale. So, but they don't have to be huge. So you see, here's one property that's 94 units. You got one that's 300 units. Anywhere in that range works pretty darn well. You just need to make sure that it's got enough meat on the bones that you can do a little bit of a value add push, so you can increase the value of that property from the time you buy it to the time you exit, and that you have strong cash flow in between. So those are the types of properties that I look for. When you start investing in this, you're going to hear a lot of different terminologies. One thing you'll hear is an equity multiple, or you'll see a symbol that says EM equals, right? So if EM equals 2, that means the equity multiple is 2, which means for every $1 you invest, you expect to get $2 out. So effectively doubling your money. So that is one of the things in my buy box of what I look for, is what that equity multiple is. I'm always looking to at least double my money. So in a 4 to 6 year time frame. So syndications, these large investments, they can have all sorts of different hold timelines. Some might only hold for 3 years, some might be 7 or even 10 years, or even a few forever holds out there. But I look for, how well is it going to do in like the 4, 5, 6 year range? I want to make sure I'm doubling my money in about that time frame. So that's one of the things I look for in the properties I invest in, and all three of these met that equation. The other thing I look for is the average annualized return. So I like for that to be somewhere in the 20-25 range. So that is basically when you look at how much return you got on your money over the hold period, and then you divide it by the number of years that you owned it. That's about what you're averaging out per year. That's a little different than IRR, internal rate of return, where it then also takes into account the time value of money. So obviously, if I give you $1 today and you immediately give me back $2, I'm really happy. I doubled my money in a couple of seconds, right? If you give it back to me 10 years from now, I'm less happy because that $2 isn't worth as much. It might not even be worth the full dollar that I gave you originally. So IRR takes into account that time value of money. So that's another thing I look for. And I'm looking for one that's at least 16%. 20 is better. 16 to 20, somewhere in there is what I'm looking for on my return. So just a little bit about what you're looking for. As you delve more into this, you do more education, you'll see more terminology that you need to look at. But in my buy box, those are the three top things. I'm looking at the equity multiple, the average annualized return, and the internal rate of return. And that's about where I want those to be. All right. Moving on. So what exactly is passive investing? What does it really mean? Well, to understand passive, we also need to understand active. So let's talk about the difference between this. So in active investing, you are acquiring it on your own. So you're going to go out there and find the property, and then you're going to buy it. If there's renovations to be done, you're going to manage all that on your own. You're going to manage a leasing person or a manager. If you're not doing that on your own, you're going to manage the person that does that for you. You're also going to manage the residents and the maintenance, or you're managing the person that's managing that for you, right? It is limited by your time, your knowledge, and your resources. And so this is most common in single family homes. There's a lot of people buy a rental property here and there, and this is kind of what they're doing. Passive investing, The deals are presented to you. You don't have to go find them. There's people have already found them, and then they're out there looking for investors to come along with them. The renovations are all managed by the partners. They're the general partners in the deal. Those are the people who usually found that deal and have it under contract. Those are the people who are going to do all of that work for you. Then you're going to have leasing and managing managers. And again, those are overseen by the partners. And again, same thing. The managing partners or the general managers or general partners, also called sponsors, tomato, tomato, they all mean the same thing. Those are the ones doing all the work. So it gives you the ability to go for larger deals and more of them because it's not adding to your workload because you're really just providing the money. So in these deals, the biggest partner is the bank. The bank loves real estate. They're happy to lend on it. And so they'll usually give you anywhere from 65 to 80% of the value of the property. The bank will come in with. The rest of it, the difference there between the purchase price and what the bank gives you, that is the down payment. Just like when you're buying your own home, right? You got to bring a certain down payment. That is what the investors usually bring to the table. And oftentimes the general partners are putting their money in there too. Most of the time that's the case. But basically that's the gap that you're looking to fill. And sometimes the renovations, unless there's a separate loan provision for renovations in there. So that's why there's partners that come into these deals. So that's passive investing. You're basically just putting in the money and then you're going to review the reports as they come in and your money's just going to work for you. And you're going to take a share of the cash flow. You're an actual owner in the properties. You're going to get the tax benefits, all of that, but you don't have to do the work. So it's great for people who have another occupation or they're retired. They don't want to be working on things. You're just going to get that passive income and your money's going to work pretty darn hard for you in these larger properties where you have these economies of scale. All right. So which is right for you? A lot of that has to do with how much time you have on your hands, but also, do you have the liquidity to buy an asset on your own? Do you have the credit to buy it on your own? And do you want to do that? You've got a smaller scale. You might not make as much, or you might do great. It all depends on the deal, but you have to find it. Yeah, so we talked about the loans. Are you willing to take the phone calls from the tenants or your property manager? I got a call, great call the other day. My property manager calls me at 6 a.m. You know it's not going to be a good day when your property manager calls you at 6 a.m. And there's a sewer line that had broken and the sewage had backed up into the bottom floor of my apartment complex. All of my tenants had raw sewage floating around the floors of their apartments, and he needed my authorization to get everybody to a hotel and for me to pay for that. So that was a fun call. Those are not the calls you get when you're a passive investor, but if you're an active one, you do have to be willing to take those calls, make those hard decisions, and fork out the money when that kind of stuff happens. You have to source the investment opportunities. You have to find the actual deals. You have to vet them to make sure they're good deals. You have to negotiate with the sellers and the brokers on the price. You have to go through the closing process on your own, and then you have to manage the investment, potentially still while you have a W-2 type of job. So you have to decide if that's right for you or if passive is right for you. So passive, again, you're still got some work to do. You have to pick the asset type that you like. And there isn't just one thing. I like apartment complexes, so I talk about them a lot. A lot of people understand how those work, so it's an easy one to talk about. But that's what multifamily is. That's apartment complexes. But you could get into retail. You could do self-storage. There's lots of different options. But you have to pick one, at least one to start with. You can, of course, diversify here. You have to define what your goals are. There's cash flow and there's equity. And you generally can't get massive amounts of both. It's usually one or the other. There's always a little bit of, not always, there's many properties where you get a mix of both, right? So in the form, that's one of the reasons I like apartment complexes, right? Because there's rents coming in and those rents get distributed among the owners after all the expenses are met. Sometimes you're doing a value add at the beginning where you're going in, doing a lot of renovations, you're pushing a lot of money into the property, so then there may not be any cash flow. And then as those renovations finish up, then you start getting the cash flow and rents come up as the property looks better. And then, but the big chunk of money comes at the end, a lot of times when that property is resold for a lot more value because you've now improved the property, right? So that's the equity component. So how you choose to invest is going to depend on if you're looking for a lot of cash flow now, because there are deals that can give you that, but they'll probably give you less equity, right? And then others, it's like very little cash flow or no cash flow and lots of equity later. New construction, for example. If you're building something new from the ground up, there's nothing to generate income. So there's zero cash flow. Most of those builders are building to sell. They're not building to then hold. It does happen. But most builders, it might take 3 years to build something from the ground up, and then they sell and then they cash out their investors. And maybe you get a really big chunk of money at that point, but you don't have any cash flow. Not a great thing to do if you're retirement needing to live off of that money, right? So you just have to decide what you want, what your goals are. You have to have some liquidity. To get into most of these deals, the minimum is usually somewhere between $5,000 and $100,000. It can vary. There are some that are as low as $25,000, but the vast majority are in the 50 to 100,000. I see deals sometimes where the minimum investment is $250,000. You got to have $250,000. In those cases, I usually set up a fund, so lots of us can put our money in that fund, because all that matters is that the fund writes a check for $250,000 or more. All the individual investors can be less. Okay, so we got some people asking for the slides. I will pop up the slide later. Again, sorry if you missed the slide that said how you can get a copy of the slides. But yes, I will share the slides, Richard. So thank you. Okay, so, and then you have to find an operating partner. You have to find someone you're going to trust to execute these business plans really well. So that's very important. And we'll talk about how you find those. And you need to be either a sophisticated or accredited investor. And what does that mean? So sophisticated just means that you have learned about this process, you understand the process, you understand the risks, you understand the rewards, you understand how long your money's going to be tied up in a particular project, you understand who you're investing with and what their business plan is. So you have to kind of show that knowledge. We don't want people just investing completely blindly in something. And so there's usually a call set up with the capital allocator or the operator or the sponsor of this deal, where they kind of vet you and make sure that you understand a few things. And they might provide some additional education resources. So you really need to understand this. So maybe read up on this a little bit, listen to some podcasts, some YouTube. It's not a lot, but you do need to know what you invest in. Just like you shouldn't invest in a stock market if you don't understand how the stock market works, right? So there should be some of that. Accredited investors is just kind of another step up. That means that you, in addition to being sophisticated, you still have to know what you're doing, right? You also have a particular net worth or a particular salary that lets you scale to some properties. I shouldn't say scale, because there are properties in both categories that you can invest in. But accredited investors usually have the opportunity to invest in deals that are exclusive to accredited investors, as well as ones that are open to non-accredited investors. And that means that you're, as a single person, you're either making $200,000 a year, or as a married couple, you're making $300,000 a year, and you're anticipating this income to keep going. Or, not and, or you have a net worth of $1 million. Okay, that's not including your personal property, your personal home. If you have rental properties, you can count those. If you have retirement accounts, you can count those. You have stock accounts, money sitting in your checking savings account. Anything you have of value counts towards your net worth. But if that totals to $1 million or more, you might have a business in there, whatever it is, then you can be an accredited investor, and you can just get a letter from your CPA or say something saying, yep, I'm an accredited investor. And that opens up the door to some deals that might not be available to all sophisticated investors, but you need to be sophisticated either way. So it's a little deceiving there. And then you need to learn to analyze the deal. So I talked about some of the terminology that you need to understand, like IRR, AAR, EM. If you miss early parts of this recording or of this webinar, I will send out a recording. So we'll go over some of that. But you do need to understand what some of that terminology means so you can look at these various deals. All right, so let's talk about the typical structure of a passive real estate investment. So you have your operating partners and you have your passive partners, okay? So as a passive investor, you are a passive partner. It's also called a limited partner or an LP. So those are all terminologies that mean the same thing. The operating partners, they can be called general partners, they can be called GPs, they can be called sponsors. Sometimes they're called syndicators. Lots of different terminology. It all means they're doing the active part, right? So they're the ones funding the investments, they're analyzing the properties, and they're putting this whole investment packet together and making it available for everybody. The passive investors, again, they're just bringing the capital to the table. They're bringing the money to meet the difference between that loan amount and the sales price and or renovations, right? And they're still going to be owners in this property. So they're going to get the monthly or quarterly cash flow, depends on how it's set up. They're going to have the equity upside on the back end when the property sells, and they're going to get tax benefits, right? So just like you would if you owned a single family home. And the tax benefits in these larger scale properties are way bigger than in your single family homes. We'll talk about that a little bit more. All right, in the benefits section. So hands-off investing approach, obviously that's the biggest benefit. You don't have to deal with all that kind of stuff. All you really want to do is keep an eye on your quarterly reports. Some properties report monthly, but real estate doesn't move that quickly. So you don't necessarily need to look at everything on a monthly basis. Quarterly is generally fine. But you want to keep up with what's going on. Potential for steady cash flow dividends. Again, it depends on the type of property you're investing in, and there are lots of different options, but there's that potential for that steady cash flow, not so much in new construction, maybe not in something where you're doing a lot of value add until later on in the deal, but that's basically like getting dividends, right? You're getting a percentage of the proceeds every month. Then you have the ability to diversify really easily. You can diversify across geographical areas. Like I just showed you, I've got properties in Texas and Florida, and I've got properties in Carolinas, Puerto Rico, all over the place, right? You can also diversify with asset classes. I might invest in some self-storage, and I might invest in some car washes, maybe some lending funds, right? I can do all of that without having to know everything about those asset classes because I'm not actively doing the work, right? I don't have to know the ins and outs of all those businesses. But that's one of the nice things about passive investing is you can really diversify well. And then the tax advantages, like I said, you're sharing those with with everybody, with the general partners. So what happens with these big deals is if you're familiar with depreciation, like you get on your own house or on a house that you're investing in, also any kind of business has items that you can depreciate. So all that means is the IRS has decided that a particular object is not valuable after a certain time frame. So let's say you have a tree trimming business and you buy chainsaws. I'm going to guess, I don't know, but I'm going to guess depreciation on chainsaws is probably 5 years or something. So you're going to say you take the value of that chainsaw and you divide it by 5, and that's how much you can depreciate from your taxes every year, because after 5 years, that chainsaw is pretty much worn out and useless. Okay. The difference, of course, with real estate is we know that in X number of years, it's not going to be without value. As a matter of fact, it's going to be worth a whole lot more. So it's really just a paper loss. And it can be a really big paper loss because we're talking about very expensive properties. And you get depreciation on the full value of the property, not just the piece that you're bringing money into. So remember, the bank is providing 65 to 80% of the money to buy this thing, but the bank doesn't take depreciation. The depreciation goes all to the investors. So it's a lot of depreciation. So it's a big tax write-off in those cases. Again, just a paper loss. And then in addition, on these really big properties, they can do something called cost segregation studies. So what they say is, okay, IRS, you're telling me this building, so let's take an apartment complex, for example, has no value after 27 and a half years. Don't ask me why they pick these weird numbers, but the IRS does these things. So okay, maybe the building as itself, you want to take the value of that, divide it by 27 and a half, and take that much depreciation each year. But you know what? The roof on here, it's only going to last 15 years. So you can depreciate that faster. And what about the doors and the appliances? The appliances are only going to last 5 years, or whatever it is. So they do this cost segregation study where they break down all the components within this building and they segregate those out. And then you get to take that depreciation even faster at the very beginning of this investment. And to take it even a step further, we had the stimulus package that came out, and that was trying to get more money into the economy. And so they said you can take what's called bonus depreciation. Bonus depreciation is where all that stuff you did the cost segregation of, you can take a huge chunk of that the very first year. You don't have to even wait for the full 5 years to depreciate it out or whatever it is. So all of that means that you get to defer a lot of taxes to later. Okay, now I didn't say it's tax-free. You get these write-offs on your taxes, but it is deferred. When the property resells, there is depreciation recapture to some degree. but you need to talk to your CPA about this. I'm not a specialist in this, right? But you've utilized some of that depreciation. You haven't utilized all of it. So there's going to be this depreciation recapture. But what it means is while you are in the investment, you're depending on the investment. And again, talk to your CPA, but you may not be paying taxes on any of the income that you're making on that. So even if you have to pay it later when the property resells and you're getting a bunch of cash anyway, so you have it to pay, you've got maybe 5 years there where you're not paying taxes on it. That's money you can be reinvesting or utilizing for other purposes. And if you get into another investment at the end of the 5 years, when this one is closing out, for example, you could get the depreciation for that to offset the depreciation recapture of the first one. So you can really just keep pushing those taxes for a very long time. So again, CPA questions to get into the weeds of that, but it is very beneficial. So yeah, I use that a lot. All right. Let's talk about some of the different types of investments that you can get into passively. So I've talked a lot about multifamily. These are kind of my two favorite ones, multifamily and private lending. So I'll talk about those, but they're not the only ones. So I will also go through some of the other ones. Now, everything has risks and rewards. Everything you invest in, doesn't matter. In multifamily, your risk is you could have an economic downturn that impacts your residents. And so then it might matter if you are in what's called a Class A apartment complex. That's like the really fancy ones with all the luxury amenities. If you're somewhere in the middle or your workforce housing, so depending on what's going on with the economy, people in luxury buildings might move down to a slightly less luxurious one. If it's really booming, you might have people who were in maybe older buildings moving to nicer ones. So you've got this teeter back and forth, which is why I like to invest right in the middle, where you get people from both ends moving up, moving down, right? But that's something you need to think about. It can be very competitive in some areas, which is why I like to invest in markets that are growing, where there's a high demand for apartment complexes. So these are some of the things I look for in these, right? Because they can be competitive. If you have apartment complexes competing against each other, they might start lowering the rents to attract tenants. You don't want that. There are always property management challenges, right? You may have to replace property managers if somebody is not performing well, and that can be a real pain in the rear. But in the case of passive investing, it's somebody else's pain. But those are the risks, is that somebody is not doing well to lease up, or they're not turning units fast when somebody moves out and you need a new person in there. But there's lots of rewards. We talked about the stable cash flow. Economies of scale is huge with these bigger properties. Especially when it comes to renovations and things. Think about if you have a single family home rental property and the refrigerator goes out. You got to go buy one refrigerator. You're probably not going to get much of a discount on that. You're probably going to pick it up at Home Depot or Lowe's or something to that effect. If I'm renovating 100-unit apartment complexes and I need 100 appliances or 100 refrigerators, I'm going to be buying those at wholesale prices, right? And the same is the case for everything, right? When I'm pay for one new roof on one single family home. I'm actually going through that myself right now. It's extremely expensive. When you're doing huge roofs, per square foot, you're going to be paying a whole lot less. When you're having a painter come in and paint 100 units versus one little place, very different prices. So you get those economies of scale, which is great. You get the appreciation. And appreciation here is different than it is with single family homes. So my house is going to be valued based on the neighborhood value, right? If my neighbor keeps their house real trashy, or if a real fancy mansion goes in on the other side of me, those things are going to affect the value of my property. And some of that is out of my control. That's not how it works in the commercial world. Okay, so an apartment complex or any of these properties that we're talking about, they're going to be valued based on how much income they're producing. So you have more control over that. The general managers are going to work hard to keep the property beautiful, to do those renovations, to get top rents, make sure it's really nice, appealing looking on the outside so people want to come in, all of that kind of stuff, because that drives up your NOI, your net operating income. And that is ultimately what determines the value of your property. So when we talk about a property being a value add, it means people are doing things to add value to these properties in order to push up the value for your exit. So you can get that big extra amount for the equity that you have at the end, right? When these properties sell. So appreciation works differently, and you can force it to go up. So it's called forced appreciation. The demand for apartment complexes right now is huge. Unfortunately, it has become very expensive to buy single family homes. Our younger generation's definitely suffering. When I was 19 when I bought my first house. Okay, most people maybe don't do that, but a lot of people were able to do that in the past. I now have a 21-year-old and 23-year-old son. Neither of them can even think about buying a home at this point, right? So we're seeing more and more demand for apartment complexes. And we already talked about the depreciation, the tax benefits that gets you. Another one that I am really, well, actually, let me not go into private lending just yet. Some of the other very common ones that you'll see when it comes to syndications are like medical offices. Those are very popular to invest in. They'll have like what's called a triple net lease, where the person renting it is in charge of all the expenses. I mean, even the insurance on the property, the AC goes out, all these kinds of things. They take care of everything. So that's very nice. And they're usually very long-term leases, so not so much to think about. So they're usually more of a cash flow play than an equity play, because they usually don't resell in a short period of time. But that's one that a lot of people like to invest in. Self-storage is another one. Self-storage has the benefit of having no landlord laws, right? There's no people living there. It's boxes living there. It's month-to-month rent. So theoretically, you could raise the rent every single month because there's no long-term lease in place. If you did that, your people would probably all move their boxes somewhere else. But you have more flexibility. And if somebody doesn't pay, you can just lock it up, sell their belongings, and move on, right? So lots of options there. Mobile home parks are also very popular because you just own the land most of the time. So you don't own the mobile home. So you don't have to deal with tenants and repairs in the same way. You just have to maintain the land and rent out the land. So there's lots of different things. Industrial became huge, especially during COVID. We had Amazon building all those warehouses, lots of warehousing, lots of shipping to your door these days. So industrial has really taken off. So I don't want you to think that apartment complexes is the only way to go. It's just something that has performed really well over time. So in my world of risk and reward, it falls really high. So car washes is another one that's taken off right now. That's another one that a lot of people are jumping on. So just want to let you know, even though I talk about apartment complexes a lot, it's not the only thing out there. Private lending is my second favorite. So the nice thing about private lending is it is cash flow now, and it's high cash flow, right? But you don't get any equity on the end, and you don't get the tax benefit. So basically how private lending works, there's lots of different ways to do it. But if you're doing it passively, you're often investing in a lending fund. So we offer one with Blue Vikings Capital, right? And it's going to pay you a certain percentage based on how much money you put into that fund. So we pay between 7 and 10% annually, right? And you just get a check every month, or just an auto deposit to your account, right? But there's no equity on the back end. You're not buying any houses and fixing them up and reselling them or anything like that. We're lending out the money for other people to do that. So we take the money that people invest with us, we package it up to loan products, we lend it out to other people, and those people are paying us interest on it, which we then use to pay our investors interest on, right? And then we take a cut in the middle. So that's kind of what we do on that part. But it's very good for people who are looking for cash flow now versus building that equity long term. So it's all a matter of where you are in your life and what you need right now. So we talked about goals earlier. That's where that feeds it. So I like to do a mix of these, where I have the equity component coming in later, and the multifamily primarily, and then the private lending for instant cash flow now. That's kind of what I like to do. But diversify is the key to everything. Diversification is the key to happiness when it comes to investing, in my opinion. So how do you get started on your own journey? Well, we mentioned you obviously need some money to start, but people often forget that there are different places they can pull that money from. Obviously, if you got cash sitting in your account, come talk to me. Not just kidding. But I mean, that's kind of where it's at, right? You could just pull out what you have. If you have stuff sitting in a savings account or something, or it's earning 2, 3, 4%, I mean, that money is not working for you very hard, right? Let's get that money working harder. A lot of people don't know that they can invest with their retirement accounts. If you have an IRA or a 401k, sometimes your employer might have given you some drop-down selection where you can pick a couple of things, mutual funds primarily. But, stock market doesn't always do great. and there aren't tax benefits, and there aren't all these other things. Tax benefits are different within retirement accounts, so you should talk to your CPA about that anyway. But the point is, if you're no longer working for a particular employer that set that up, you now own that IRA or 401k, which means you can decide what to do with it. And you can put it with a custodian that lets you self-direct it. So you basically tell the custodian, hey, I want to invest in this apartment complex or this car wash, or I want to do this private lending or whatever, and they will put your money into those things. You can use the self-directed account for just about anything. You can go buy gold bars with it if you want. So you are not restricted to mutual funds with these investment vehicles, which is what a lot of people want you to believe. You can set up your own if you don't have one from an employer. You can set up your own, start funding it, and then yeah, especially Roth IRAs and 401ks, those are wonderful. You pay the taxes up front, but then as you're doubling your money every 4 to 6 years, and then eventually you pull it out, you're never going to pay taxes on that money. Super powerful. So something to think about. Brokerage accounts. A lot of people have a lot of money locked up in brokerage accounts, especially now during elections coming up and stuff. We will see a lot of volatility in the market. So you may want to diversify some of that into real estate. So you might want to pull some out of that and put it into something else. Just some options out there. So that's some of the areas if you can't find the money in your couch cushions. So how do you start passively investing? So first you want to do a financial assessment, right? See if this is even right for you. Is this something you're comfortable with? So that means you're going to want to do some education. And we'll talk about, you can find all sorts of stuff that's free out there. There are lots of great books too, but there's lots of podcasts on this. If you're a podcast person, I listen to audiobooks while I'm walking the dogs in the morning when I'm exercising. So lots of great podcasts on this, lots of great audiobooks, lots of YouTube videos out there. I've got tons of stuff on my website, bluevikingscapital.com, lots of education on there. So you need to figure out, is this something you're going to be happy with? Then you want to find a capital allocator or a operator or syndicator that you can invest with so that they can start presenting these deals to you, because you're not just going to find them with a Google search. Most of them are going to require a discovery or qualifications call. That's how we kind of figure out where your sophistication level is, and you get to ask us all those questions about either a specific deal or the investment process as a whole, or whatever burning questions you have. It's really just a call to get to know each other. There's usually no investment opportunities offered on those calls. It's purely a get familiar with you kind of call, but you have to do those calls in order to qualify to be able to get into these deals, right? And then you can join the investor clubs. And the investor clubs, once you're in there, that lets you get on the lists to get these offerings. So as they come out, you'll see them. And I always recommend, don't invest in the very first one that comes your way, right? Look at a couple, but go ahead and set up a call to discuss it further with your capital allocator, right? Say, okay, I saw this deal. I'm probably not going to be investing in this, but tell me about it. Tell me more. I want to learn this. There's usually a webinar or something that you can watch about whatever the investment is. Listen to the webinars, go to them, even if you're not looking to invest in them, because you'll learn every time, and you'll start to pick out things like, I really like properties that refinance in year 3, or they have a business plan that exits in year 4, or whatever. You're going to find the things that you like. So then you'll know what to look for, and then you'll be able to make a quick decision when you find the deal you really like. And that's going to be key. Like, some of our investor lists are very large, thousands of people, and we'll have an investment where we have room for maybe 30 people. Or maybe 40 people. So it's going to be the people that act the fastest that get in on those deals. So you have to be able to make those quick decisions. And you're not going to be able to do that if the first time you've looked at an investment opportunity is that one webinar or that one operating memorandum or pitch deck. There's lots of different terms. You need to be familiar with it before you're looking to invest. So start getting that knowledge and just sign up to start getting those offers, right? So that you can move quickly when the time comes. If you would like to get that education component down, I have a book that you can download for free. So this is just how to choose your first passive real estate investment. If you've done passive investing in the past, it can also be a little guide to how well you're doing, right? Have you been checking on the market? Have you been checking on your operator? Have you been, there's little checklists in there on some of the step-by-steps that you should be taking with every investment opportunity. So if you haven't been doing that, please do that. So you can scan this QR code and you'll get that. I see some people putting stuff in the chat that they would like to get a copy of that. So yeah, I've got the chat. I will send that to anybody who isn't able to scan this for some reason. Maybe you're listening to this while you're driving. So I'll go ahead and send that out to anybody who wants it. And I'll have my contact information on the last slide too. So let's review what we've gone over here because we kind of covered a lot. So we've covered being an active versus a passive investor and what that looks like, the structure of a passive investment, the benefits of passive investing, the different types of asset types and the different classes within those types, and basically how to get started. So if you missed any of that, you can grab the slides and then you can go over that on your own. I can also send out a recording of this webinar if you'd like. But if you want the slides texted to you or sent to you, just text slides to this phone number right here, and that will pop up on my phone and I will send you the slides. So if you haven't done that already, let's do that. Gonna leave it up for one more second and we're gonna go on. All right. So what does the investment process look like? For those who want to say, okay, if I decide to do this, what's it look like? So that preliminary call, that is important. You do have to set that up so that we can get to know each other and make sure this is a good fit. I don't like anybody investing with me where if all they have is $25,000 and they want to put it all somewhere. That is not a smart move. You should always be diversifying your money. There are risks to all of these investments. You know, most of them do great, but you can lose money and you need to understand that. So I don't want to take the last $25,000 and be responsible for putting that into a deal. I had somebody recently, they had $1 million they wanted to put with me. I said, great. And they're like, find me the deal. I said, nope, we're going to put this into 5 different deals. Let's break this up into smaller bites, right? So we want to get on those calls, hear where you're at, see what might work well for you. Are you looking for cash flow? Are you looking for equity? Some combination of both. Let's see what might be a good fit. Once you get qualified, you may also, if you want to be an accredited investor, you might need to also provide a CPA letter that shows that you're accredited so we can get you into those types of deals. Not required. But then once you're accepted, you get into the club and we can send you these offers, right? And then you need to start reviewing those and looking at the merits of each deal. And then when you find one you want to invest in, you're going to put that in. We'll have what's called a soft commitment form where you basically say, I'd like to commit to this amount of money for this deal. At that point, you're still not on the hook for anything. That basically just shows a high level of interest and it secures your spot. Again, these things move quickly, right? So you want to get on that list and say, okay, hold this spot for me. Then you get all the legal docs. And the first time you see all these legal docs, it's going to scare you. So I'm just warning you up ahead because they're really long and it's a bunch of legalese. But we can walk through it with you. We can get on the phone and say, okay, what are the really important parts here to pay attention to so you understand what your obligations are. And it isn't until you actually sign those docs and wire in the money that you're on the hook for anything. Really, it's not until you wire in money. So go ahead and get on the list if it's something you think you want to go into. And then after that, you're just welcome to the project. You're now an owner of this apartment complex or the self-storage unit or whatever it is. And then you want to start reviewing those reports. So that's kind of what the process looks like. Obviously, there's more details. If you want to look at becoming a part of my investor club, you can scan this and we can start sending you deals, but it will send you an email saying, please set up your call. Right? You're going to need to set up that call. Those kind of go hand in hand, but we're happy to start sending you things to look at to help you start vetting deals and see if this is something of interest. But do set up those calls too, because that really makes it real and you can get all those questions answered. All right, leaving that up for one more second here for you. All right. So again, remember, I'm a capital allocator. I work for the investors, not for the deal sponsors. So I'm far less biased than if you're speaking to someone who's trying to close their own deal, right? The timeline is ticking. They need to raise this money in a certain amount of time. So they could really start pressuring you. There's never any pressure if you choose to work with me. I'm vetting opportunities for my own money. And then I let others invest alongside me, or I make that opportunity available. So there's never any pressure from my side. It's just by pooling our money, I can negotiate far better returns for all of us. It's very common that people who invest through me get a better return on their investment than somebody else who's investing in that very same deal, but they're doing it on their own. Again, we're pulling our money, we're bringing it in, oftentimes as a fund where we write one large check based on everybody's investments, and then we share those higher returns. So that's kind of why I got into this, is to make my money work harder. It's the same money, same deal, might as well make it work harder for you. So that's kind of what that's all about. Yeah, and then you also have that third party person that's looking out for your interest in that property. So my services are always free. So use me, use my knowledge, use my experience, and I'm here to help you navigate all these opportunities, right? So with that, I'll take any questions you might have. Feel free to just put them in the comments here. So I see Richard, Andreas, and Sue all asking me to send them things. I will do that. I will do that. Thank you, Karim. I appreciate it. Great job explaining. I learned a lot. Appreciate it. Yeah, so if there are any other questions, I'm here to take them for you. I'm going to write down these email addresses while they're on the screen, just in case this cuts out on me, which happens occasionally. I must have explained really well. No one's got any questions? That never happens. Oh, here we go. Nice order. I ordered your book, but I realized I already have the book. Okay. Well, thank you for already having the book. I appreciate that. All right. Thank you, guys. Really appreciate it. All right. Well, I'm not seeing any questions on here. Maybe someone's busy typing though, so I'll stay on a few more minutes. If not, okay. How much better if invest with you versus invest with operator? The percentages really vary. It depends on the deal, depends how much money we're bringing to the particular deal, how much we can negotiate. But oftentimes operators have these different tiers where they'll say, if you're investing at let's say $50,000, we're going to give you a 7% preferred return. And don't worry if you don't understand what those various terms mean. But basically, it means you're going to get 7% back on your money before you split any profits with the general partners, right? So you're going to get the first 7% to you before anything gets split. And usually the split on the other end might be like a 70-30 or an 80-20. And then if someone's investing, say, 500,000, maybe they get an 8% preferred return. If they're investing $1 million, maybe they're getting 9% preferred return. If we collectively bring $1 million or more, we're going to get that top tier, right? So all of us then get to share that bigger tier. And then we may also be able to negotiate a better equity split beyond that. So maybe I had one recently where we got a 90-10, 90% of the profits, even after the higher preferred returns went to us. And I've even been able to negotiate where on the end, we get an additional kickback of 100 grand to split amongst the investors. So all sorts of different things, but there's not a set rule. It depends from project to project, but generally it is better. So, do you have any deals right now? Okay. I don't have any right now other than the private lending. And the reason for that is I really just pick one deal per quarter. Again, I am pulling money out of my own businesses each quarter to invest in something. So I spend a quarter, about 3 months, analyzing deals and finding the very best one. And then I'm talking to those sponsors, right? I want to vet them. I want to make sure they're good apples, and that I want to put something in there with them. And then I negotiate. I'm like, okay, how much better can we make this deal if we bring X amount of dollars? And so that's what I spend all quarter doing, basically. And then at the end of the quarter, I'm pulling my money, putting it in there, and then I send it out to my investor pool to see who else wants to join. So I usually have one deal about every quarter. Every now and then I find something really good I can't resist, and I might do an extra one somewhere, or I might skip a quarter if I don't find anything good. Right now, the market's in a weird place, so there's not as many deals out there, so you got to vet them really carefully. But the deals that are out there, some of them can be incredible because the people who are selling right now are people who really need to sell, so there's a lot more negotiation. Sometimes it's not necessarily because the property is distressed. It can be, but sometimes it is because the timeline of when they said to their investors they get their money back is up, so they have to sell their property right now. And sometimes it's because they're in some sort of distressed situation. Maybe the increased interest rates have been hard on them. Maybe they didn't lock those interest rates in. So it's something I talk about in my book is what are some of the things you should look for. So one of them right now is locked in interest rates, right? Because we don't know where they're going. So, all right. So what is the least amount you will take on private lending? On the private lending side is 25,000. 25,000 is the bottom on that, and that pays 7%. Once you get over 100,000, it pays 8%. Over 500,000, you're at 9%. Over a million, it's at 10%. So that's what the private lending is doing right now. Yeah. So let's see. Okay. Not seeing any other questions, but if you got them, I'm here for a few more minutes. But look forward to getting to know some of you. Please reach out. Happy to set up a meeting anytime. Happy to get you any additional resources. If you want recommendations on other books or podcasts or anything, just shoot me a message. Happy to get that to you. So have a wonderful afternoon, everyone. Thank you again for joining me, and I will send out the recording. And I've got the email addresses here for everybody who asked me to send them things. So I've got all of you right here in front of me. So thank you so much. Have a wonderful rest of your day. Take care.